recent events. I think we have all followed the U.S. elections. President Trump returning to the White House. But not only that, Republicans taking control over both chambers of Congress, the Senate and the House. We have seen the immediate impact on markets. U.S. equities rallying, U.S. dollar strengthening, probably as a result of expectation that the treasury rates going up. But I think today what we really want to focus on is a bit more the mid and long term, and seeing on how some of these policies which are talked about, tariffs, immigration, and many more, will impact the market. But maybe let me start off with a broad question on how do you expect the second term to be different than Trump's first term?
Sure. Well, thanks. But I'm going to answer the question, but first, let me just express my gratitude and thank you to you, Sebastian, and to Syfe for your support. And thank you to everyone for coming out today. I'm here with my colleague, Brian Rista. Our firm is Kraneshares, and we are delighted to be a partner here in Singapore with you and your firm. So thank you for that. The U.S. election was a monumental election 2 weeks ago. Donald Trump received, I think, a clear mandate coming into his second term, and he's term limited, so his second and final term. And of course, all the world is doing two things: trying to look forward and figure out, what these next 4 years will bring for business and for peace and security. And the right place to look to answer that question is the first term. And it's to look at the experience Donald Trump had in the first term and to try to glean from that experience what lessons he may have taken. And I think this is the key. Donald Trump had some hard lessons in the first term. He did not understand the United States government when he first came to Washington, and it took him a year or two to figure it out. He did not understand the size of the U.S. government. I heard it said recently, he was asked by a journalist what was the biggest surprise, and the biggest surprise to him was how many people he had to hire. That on the first day, there was 1,000, literally 1,000 very important vacancies, jobs that were open, that were awaiting his nomination, his appointment. So we can see he's gotten underway very quickly with the process of designating nominees to serve at the high levels in his new cabinet. And therein lies lesson number one: move quickly to set up your team. Lesson number two, I think he took from his first term, is the composition of that team. He did not know anyone in Washington. He took a lot of advice from sort of inside the Beltway, Washington insiders. I think he regrets taking some of that advice in the first term. He sees himself as the only principal in every organization in which he is a part. And what he learned in the first term is when you appoint important people who have their own center of gravity, if you will, they act as principals, and they don't necessarily always act in lockstep with what, in his case, the president wanted. So the type of team he is assembling this go-round is quite different in character. They're smart people, they're ambitious people, but the first test he has applied clearly has been loyalty to Donald Trump and a recognition that Donald Trump will be the only principal in the next Trump administration, and the others will be, for lack of a better term, staffing Trump. And these will include even secretaries at Treasury, Defense, and State. I think will all operate much more deferentially than was the case in the first term. Now, what's going to be very different, if I can, just to sort of tee this up, is in the same way every president wins and loses their election in the United States on domestic issues, what every president usually finds is on that first day in office, the top items in the inbox relate to international relations, war and peace. And that will be the case on January 20th when Donald Trump returns to the White House as president. He has three major issues at the top of his inbox, all of which relate to war and peace. First, the war in Europe, war in Ukraine. He made statements along the campaign, really has made statements over the last 4 years about his thoughts about the war in Ukraine and his confidence in his ability to bring about a ceasefire or maybe even peace, long-term peace in Europe. We'll see. The second item that was not in his inbox in the first term that is a high priority is war in the Middle East and the question of Iran and how to isolate Iran and create a more constructive environment for peace in the Middle East. And then third, and this will be the topic I hope we'll spend most of our time on, there's an item that was very much in the inbox in his first term that he had begun to work on in earnest until he was interrupted by the global pandemic, and that is U.S. China relations. So on those three top line issues, all of which relate to international relations, the top two are about security, war and peace. And the third one, I think Donald Trump sees as a purely economic issue. While you'll hear a lot of talk about China and security as it relates to the United States, he really will view, and his team in support of Donald Trump will view the China issue as one that relates to trade and investment and the global economic competition.
Yeah, and he clearly actioned very fast some of the learnings. I mean, I think there's already at least a dozen names out there of people he wants to appoint on kind of day one, from the Secretary of Health to general attorneys and so on. But I think you brought up a very good point on the China relations. And I think during his campaign, one thing he really repeatedly said is tariffs. And I think, quote, is one of his favorite words, I think he said. And I think what he has in mind, or what he shared so far, is that he want to do 10, 20% tariffs on most countries and anything up to 60% on China. What does that mean for the US economy, but then also probably on the Chinese economy and maybe the rest of the world?
Yeah, well, you're exactly right. He has described himself, I think he says he's in love with tariffs, or tariffs are better than love or something. He has some quote that was very striking. A lesson he learned in that first term was you can't do everything you want as president. There's a Congress, there's a judiciary, and in fact, some of his programs, his policies were rebuffed by either the courts or by the legislature. But he learned that the one thing you can do in the American system of government is, if you're willing to invoke it in the interest of national security, by executive order, you can impose a tariff, a tax on goods and services imported into the United States. And by the time he entered his second or third year of the first term, he very liberally used that tariff pen. And it wasn't just about China. He used the tariff pen to prosecute his grievances all around the world. He imposed tariffs on American allies, Korea, Japan, Canada. He imposed tariffs on Mexico and European countries, Great Britain. So he's going to, again, very liberally use that tariff pen. And I think most specifically, or with the steepest initial tariffs, they will be directed to China, America's top economic competitor. So you asked the question, what impact will that have? And let me first say, why? What's the why? What Donald Trump is trying to do, in my view, is to create the conditions, create the environment for a grand bargain, for a major deal with Xi Jinping, because Donald Trump, like all second-term American presidents, will be seeking to cement his place in American history. He sees himself ultimately as worthy of, his face being on Mount Rushmore. He sees himself in the sort of mold of Ronald Reagan, a strong man, great man, doing works around the world based on his personal relationships with other world leaders and on his strength and the strength of America. And I think what he will do, unlike the first term, is he will start off immediately, maybe even in that first day or first week in office, and use that tariff pen to impose very large, broad-based tariffs on goods imported into the United States from China. Now, there's a story that comes out of the first term that didn't receive much attention that I think will be worthy of attention in the second term. And that is, on the same day he imposes those tariffs, he sets up a process by which manufacturers or other applicants can seek exemptions to the tariffs. And what we learned in the first term of the approximately $300 billion in goods, Chinese goods imported into the United States, by the time that process had run its course, a very substantial portion of the $300 billion in annual trade that was subject to the tariffs was exempted from the tariffs. That's the part of the story that American voters, American consumers didn't really see. The newspapers wrote about it, but it was less interesting than the top line. So I expect there will be a similar process by which applicants, petitioners can seek exemptions from these very steep tariffs. Nonetheless, the tariffs will have an effect, and they will have an inflationary effect on the U.S. economy. 10 out of 10 economists agree that an increase in tariffs on Chinese goods imported to the United States will cause some inflationary pressure. There's a disagreement as to how much, but that is a problem for Donald Trump and will cause him to have to walk a very difficult tightrope. He was returned to the White House, or will be returned to the White House, in part because of American anxiety over inflation. American consumers were very dissatisfied with the Biden administration because they felt as though the cost of living had outpaced their increase in wages. Donald Trump understands that and talked about it, and he's going to have to very carefully consider the inflationary impact of tariffs on the American economy. Now, you asked about the effect on China. This is a very challenging question. China also learned a lesson from the Trump administration. And the lesson they learned is that it's not only foreign companies that should diversify their supply chain, but Chinese companies also have a responsibility to their shareholders to put in place certain protections from this type of more antagonistic trade policy. And they have spent the last 4 years or 8 years, depending on when they started to recognize this issue, actually diversifying their own supply chain and even moving some of their production very famously outside of China to protect themselves from these tariffs. So the tariffs will not have the same sharp effect that they may have had on the Chinese economy, and in particular on Chinese producers in that first Trump term. Nonetheless, they will have an impact. And I think they will probably have the desired impact. I think they will cause enough tension, enough difficulty for the Chinese economy to bring China to the table for a good faith negotiation of a mutually beneficial deal. Another thing that's different, I keep talking about what's the same and what's different, is the Chinese economy is quite sluggish. And Xi Jinping knows that. He has a project. His project is to continue to bring these hundreds of millions of people out of poverty into the middle class and to find upward mobility. And the only way he can do that is to continue to promote policies for, quite impressive growth year on year in China. And in order to do that, he knows that China will benefit from a more free trade environment with the United States. So he is strongly incentivized, President Xi is strongly incentivized to come to the negotiating table, as is Donald Trump, for purposes of cementing his legacy and hopefully unleashing tremendous economic growth in the American economy.
So would it be fair to say it's definitely more than just rhetoric? We do expect him to implement some of these tariffs.
I do.
In the way, it's something to get China back onto the negotiation table and find ways on how to make it work for both.
Yeah, absolutely. Look, any deal, we're in a bipolar world for the foreseeable future, for the rest of the lives of everyone in this room, and I hope we all live very long lives. We're in a new world, a bipolar world. The Cold War ended. There was the 1990s of this sort of unipolar, undisputed heavyweight champion of the world, the United States. Well, times have changed, and we're in a new bipolar world with two economic competitors in a single global economy. And China is at a point where they want a deal, and the United States is coming to a point where we, the Americans, want a deal. So the environment sets up well, and what will happen is Washington will spend the next, I would say, 1 year working hard to create the conditions for a maximum leverage when that deal is finally negotiated. So it's more than rhetoric. It is policies that will be put in place very quickly to create leverage, as quickly as possible.
One more topic before we move a bit more to capital markets is around budget deficits and tax policies. I think a lot of during the campaign, it was a lot about how to cut tax, a lot of pro-business kind of initiatives, probably a lot of things which actually benefit not his really core voter base, which is really like working class, but which benefits a lot of like the more affluent people. How can he balance some of what he promised in terms of tax with the budget deficit, which is at an absolutely all-time high? I think is next year, I think 20% of GDP spent on interest, if I quoted correctly. How can he benefit, or how can he balance both, the tax cuts he promised, as well as keeping budget deficits under control? Or is keeping budget deficit under control not really a priority?
Well, again, let's look at the first term. It was not a priority in the first term. Donald Trump did not seem to have great interest in.
There was one specific situation, which was COVID, which he would at least use as an excuse on why it was required to spend heavily.
One can never know what would have happened in the Trump first term had there not been a global pandemic. But there did not seem to be a heavy concern with deficit spending, the pandemic notwithstanding.
Fair.
And I do not expect in a Trump second term that Donald Trump is going to hold back on spending or tax cuts in the name of a deficit that his successor will inherit. Maybe if he was in the first term, he might be more concerned about a recession or other issues, but he doesn't face the voters again. And in some ways, that's very liberating for Donald Trump. And certainly with regard to fiscal policy, it's very liberating. So I expect the U.S. government to increase its deficit position. As a result, a combination, I think there will be government spending and government stimulus if necessary. But I also think there's going to be not just a continuation, because the Trump tax cuts from, I guess, 6 years ago are up for renewal. So not just a renewal or continuation of the so-called Trump tax cuts, but even new measures that will only result in an increase in the American deficit. And his successors will have to deal with it.
And you mentioned earlier that the Chinese economy is actually, I think, sluggish is the term you used. A lot of problems in the real estate sector. A lot of even like the Tencents and Alibabas and so on, I think way below their all-time highs. And Kraneshares is, I think, the leading ETF provider for Chinese equity markets. So like what are the key drivers why you think they will recover, and how can a recovery look like actually?
Sure. Well, this is the big question investors are facing. And let me just set it up by, commenting on the sort of the state of the Chinese economy. When I describe it as sluggish, I think the primary cause of the Chinese economic challenge is a lack of consumer confidence. It's really about consumer sentiment. Unlike most other major economies coming out of the global pandemic, there was less revenge spending. We expected there to be, more revenge spending, but Chinese consumers were more cautious than their counterparts, say, in the United States or in Europe. So there is still the a coiled spring of the Chinese consumers, even since the pandemic, even though the pandemic arguably is, behind us by at least a year now. So we first expect that government policies coming from Beijing will be designed to address consumer sentiment, consumer confidence. And we think they'll be effective. And we think that we've seen the beginning of that with sort of the first two announcements and the beginning of the Chinese stimulus, if you will. And we understand that President Xi will also learn the lessons of potential inflation and not sort of slam on the accelerator to stimulate the Chinese economy and run the risk that he would have his own inflation problem. But rather, we believe that the Chinese, and there's two meetings in December that will tell us a lot. We believe that Chinese policymakers on both the monetary side, which they've already started to do, and on the fiscal side will seek to address consumer sentiment slowly over quarters and maybe even over years. I wouldn't say tapping on the accelerator, but not pushing the accelerator all the way down. And we're going to see results, we believe, very strongly. We have very strong conviction that Chinese consumers will regain their confidence, and you will see the results of that at the Alibabas and at the Tencents. You asked the question sort of, why are those equities undervalued? And we think they're undervalued in part because by comparison to the U.S. markets, it looks harder. It's been more of a long-term grind with the Chinese equities, especially in the last, I guess, 3 years, three or 4 years. And with American equities so frothy, all-time highs virtually every day, what we have found is, and the research is clear, that the gap between value, between pricing for between American equities and foreign equities, and in particular Chinese equities, has never been greater. So for investors who are, looking for growth and looking for upside, we think they're very limited in the U.S. equity market, as hard as it is to withdraw from U.S. equities. And we think the greatest opportunity is in the Chinese market. There are a few other foreign markets that are also very interesting, but we think China represents the greatest opportunity. But it's not across the board. We think that the greatest opportunity for investors in the Chinese economy is in sort of the new economy, in e-commerce, in the type of companies that are in our K-Web basket.
As you can see, this is basically at a low over the last 10 plus years. So it's basically cheaper than they have been in the last 10 plus years. And the next slide basically shows how many Chinese investors are buying Chinese listed stocks on the Hong Kong Stock Exchange. So it's also an indicator on their bullishness on the Chinese market. Would it be fair to say that that they're not going to step on the throttle immediately? Will reflect also how the stock market performs. So it's more of a steady increase rather than a slow and steady rather than a very steep and quick recovery or recovery rally.
Yeah, I think so. I think, and that's not just sort of capital markets. I think across the Chinese economy, I think, as you might expect, Xi Jinping and his team, want a steady, stable growth. And there will be rallies along the way and opportunities for investors along the way. But we're long China. We're a long China firm because we think that the policymakers have a long view. It's almost a cliche that Chinese policymakers have a long view. But last time I was here talking to you and a different group of investors, I had a slide. I don't have it this time. I had a slide that showed one company, Amazon, had a market cap that was substantially greater than the entire Chinese internet sector, and it was making the same point that this makes, the same price to earnings ratio point that this makes. So we think that China was undervalued then and continues to be undervalued today, but that's beginning to change as we see Chinese investors come into this market. And then there's another group that is coming into this market that we think may be even more revealing, and that is the owners. The companies themselves have engaged in very aggressive stock buybacks over the last quarter. Some have been doing it, consistently over time, but without exception, the companies that comprise K-Web are all engaged in stock buybacks at different levels, some more aggressively than others, but they're all going in that direction. If you believed that the Chinese economy was in for sort of a long, difficult road, you would probably hoard cash. These founders, chairmen, CEOs, boards are actually doing the opposite. They're increasing their equity positions in their own companies, which we find to be very encouraging. No one's closer to these companies no one understands the undervalue right now in the capital markets of these companies. So if I was individual investor, I would pay close attention to the very aggressive buyback activity. The K-Web companies, I've heard it said that without exception, every one of our companies in K-Web is led by either the CEO or the chairman is a founder of the company. And these founders have all decided to double up and engage in aggressive, in some cases, very aggressive buyback programs. I think this is very revealing.
How do you see Singapore in such a new world order? What can Singapore's position be, and any word of advice on how you think they should position themselves?
Well, it's not for me to give advice to Singapore, but what I will do is make observations. Singapore has a track record here. During the Cold War, Singapore, in many ways, bet on the United States, bet on the West, and the bet paid off. We know from the way the Cold War ended. But subsequent to that, if you look at sort of post-Cold War Singapore foreign policy, no country has done a better job of balancing the U.S. and China. I credit Mr. Lee Kuan Yew with sort of, laying down the basic tenets, the basic principles that are guiding Singapore's foreign policy. But, these new teams subsequently, I think, have done an excellent job executing on this balancing. There is no country in the world, I think, that is more trade dependent, or no larger economy in the world that is more trade dependent than is Singapore. So Singapore certainly has a vulnerability, and we saw so much of that in the years of the global financial crisis. Singapore is one of the first that goes into a recession and one of the first that comes out of recession. So Singapore's vulnerability is sort of world famous. Nonetheless, I think Singapore has done a better job than any other country on the globe of balancing Beijing and Washington, and I would expect they will continue to do that. A very large investor, as we know, in China, a very strong security partner of the United States, and economic partner of the United States. So I'm not offering advice to Singapore policymakers. Many of them are my friends, but I am observing that thus far Singapore has done a magnificent job of balancing, and I expect they will continue to do so.
Very, very insightful. How will there's BRICS, right? And they trying to do trade outside the dollar. How do you see this being affected by this changing world order, by some of the policies which Trump wants to have? Is de-dollarization real, or is this something which might happen?
Well, might happen. It's always easy to say yes to a might happen. I suppose anything is possible. But my view is the U.S. dollar continues to be, I'll say it again, kind of the heavyweight champion of the world, and will continue to be not just the sort of reserve currency, but the dominant currency in trading around the world. The BRICS grouping is interesting, and China's interest in creating and Russia's interest in creating alternative currencies for trade is understandable for purposes of trying to protect their economies from the potential or the threat of economic sanctions. But I think the head start, if you will, the scale and the power of the American dollar, not just as the backstop, but as the daily currency in trade flows and capital flows, will hold its position of primacy and extreme primacy for the foreseeable future. The BRICS grouping, in some ways, I think, and the emphasis we're seeing from Beijing on BRICS is Xi Jinping's way of trying to create some leverage in anticipation of what I think he hopes will be some sort of a mutually beneficial deal with the United States.
Great. Really, thank you for your time today. I think it was a very insightful conversation. Again, thanks for continuously supporting us. We use Kraneshares products in many of our portfolios, from our China growth portfolio, but even our core equities portfolios, as well as we have all of them available on our brokerage platform. Yeah, thanks again for coming to see us. Really appreciate you all attending today. And with that, I'll pass the mic to Kenny, I think. Yeah, thank you very much.
Thank you. Thank you.